Hi, everybody. My name is Gary Dean, and as Renee said, I have been working with Woody Dorsey with sentiment timing for about 4 years now. And what I want to go over is the importance of sentiment, how we use it in our newsletter, and how we use it to time the market and really just kind of stay on the right side of things before some turns happen. So let me just kind of move my slide here. Okay, there we go. So whether you're a day trader, swing trader, investor, the key to making money is putting the odds on your side. There's no software or person that is going to be 100% correct all the time. But the markets can be predicted, especially in the short term, and that's really what we concentrate on. We don't really worry about the big picture or a 5-year time period. What we try to do is get ourselves in front of the swing trades that are going to produce anywhere between, we most of the trades that that I get into through our system is anywhere between 50 and 100 points on the S&P. There's a code that the market follows, and the presenter before me was going over the Fibonacci's and how things continue to repeat, and that's the same exact thing, but we concentrate on the S&P 500. But there's a code it follows, and it's always changing. And what Woody Dorsey, he's been doing this for over 40 years now, and he's kind of mastered this code. And what we really want to let people know is, when is it safe to be buying? Should you be selling? Should you be looking to short the market? Or one of the positions that not a lot of people, believe is a position is just staying in cash. And in today's webinar, what we're going to talk about is how to diagnose the S&P 500 to make better trades and stay on the right side of the market. So, who we are and what we do. We're one of a handful of services that actively tracks and charts investor sentiment. And Woody Dorsey is considered by many on Wall Street and really around the world as one of the pioneers of investor sentiment and market psychology. So technical timing profiles. Now that is something that's important because knowing what sentiment is, that actually backs up the projections as far as when the S&P 500 is set to be making some type of top or a bottom. So the technical timing profiles are what we use to predict when reversal dates are scheduled to hit the stock market, and they're usually weeks and there's sometimes months in advance, which I'll show you in this presentation. But the technical analysis is what I do, and that's where we use to determine where the S&P is going to reverse. So when we have the time period from the technical timing profiles, we then can go take a look at the sentiment, how investors feeling about the current trend. And most, if not all, reversals are going to take place at some type of sentiment extreme. So they're going to be very bearish at the lows, and there's usually a reversal that's pending, and they're going to be very bearish at the tops, and that's when we're looking at some type of reversal to the downside. But it all has to be looked at, and that's what Woody has really mastered through the years that he's been doing this. So Woody, he's been in just about every financial media. One of the articles that I like to show is the USA Today, and they call him the stock shrink. And it's he's been in the business. This is 35 years. It's been 5 more years since it. So 40 years. He's a best-selling author of behavioral trading. And that's actually the book that I read that after I was running my own newsletter and I was a financial advisor, where I decided to call him because I knew he was only working with the institutions, and some of the largest ones in the world still rely on his sentiment information and technical timing profiles. But He's considered by many on Wall Street as one of the best market timers in the world, and he's been featured on CNBC, Barron's, Smart Money, Squawk Box, and Bloomberg. So human errors in market opportunities. This is probably the basis of our entire way that we diagnose the market, because human beings in the markets are irrational, and there's always going to be an irrational element at work, and that is what creates market opportunities. Now, Woody has proprietary database and stock market sentiment that is collected through daily pollings and effectively filtered through thousands of sentiment sources. So when he gets his sentiment data, they're from thousands of sources, but those sources are then multiplied. So by the time the sentiment readings come in, they're diagnosing hundreds of thousands of people and how they feel about the market. So our market timing matrix is pretty simple, and what we want to do is we want to look at the time aspect, and that is when to expect a market to reverse and trend. And as I mentioned, Woody has proprietary technical timing indicators that have been pretty spot on for a very, very long time, where they're projecting future turns in the market, whether it be a high or a low, or whether it's going to be extending or not. And from the time aspects, once we have that in place, we want to again check and see how traders are feeling. Are they supporting the if it's a top or a bottom? If we're looking for a top, are we seeing that there's an extreme bullish sentiment where what we call them is the herd doesn't believe that the market's ever going to go down? And as long as it's running into the time period that we are looking for, we then go to the price, which is the technical analysis, and we start looking for our other divergences that are supporting the market turn that is expected, and the sentiment is supporting that. And from there, we're able to take a look at where price could turn. And one of the things that I do rely on is Fibonacci extensions and retracements. And I also look at different patterns that are in play, and from there we just come up with a narrative as far as when, where, and why the the S&P is looking to make a reversal. And some of them are going to be larger reversals. Some of them are going to be a minor reversal within a larger trend. And what the thing is, when you're able to kind of have an idea when these reversals are taking place, if you just like to look at, say, the long side, and we're heading up, but we're heading into a time period that there's a reversal that's forecasted, and we know that sentiment is at extreme bullish readings, and we're seeing divergences. What one can do is simply step out of a long trade, wait for the market to come back into a support zone, and then from there buy again, and just continue to repeat that process. Now, the more aggressive traders can look to either step out of their long positions and go short, but these patterns repeat over and over. And like I said, sometimes they're shorter patterns within a larger trend, and you can trade it whatever way you want on it. But there's a lot of points that can be made when you're getting in and out of the S&P or whatever you're trading when these reversal dates are pending. So what is sentiment? Sentiment is how investors feel about the market. And most technical indicators, they only derive from price. So when you have your MACDs, your price oscillators, whatever you want to look at, they're based off of the price of the S&P, which these indicators are fantastic. They've been used for hundreds of years, but sentiment is a measure of human emotions. And the reason why that's important is that human emotions are really what is moving the market, because if people feel that the market is going to head up, they're going to be bullish and they're going to be buying. Now, there's a time period that it comes to when there's an extreme on that. And there's a saying that's been around forever. It's when too many people jump to one side of a boat, the boat's going to tip. And the same thing goes with the stock market. And when you get in these extreme sentiment readings, whether it be on the bullish or the bearish side, and the sentiment, the difference between this and a lot of just your regular price technical indicators is that they have patterns, which I'll show you again in a little bit in this presentation. But the lows or the bearish sentiment act a lot different than they do on tops, because tops take a process. It's a process. So you're going to get your drops that come down and go back up, but sentiment typically remains at that extreme, because even the little drops, when they get bid back up, it just kind of gets in everybody's head that the market's never going to go down. So what happens is people get more bullish on the market, and that is typically when we start looking for that reversal to the downside. And the fun part about the downside is that if you're in at the right time, they just happen so fast that you can make a lot of money on in a day or two. But what happens is you're going to get the sentiment reading that is really going to kind of give you the true low. And when it gets down there and you see panic or people just not thinking that this market's going to go back up again, we're going to get the extreme bearish readings, and typically they're happening right at some type of support level, and it then marks a great buying opportunity. So extreme sentiment, it doesn't always mean that price has to reverse. It's an indicator, but from there, we want to know, is the time aspect of it, are Woody's timing profiles looking for a reversal at that time period. And then on top of that, you go from the technical aspect of it to see if there's divergences or support or resistance. So the tracking of both intermediate and shorter term sentiment offers a clear view of price reversals, and it might be near. And that's what I was talking about before, where a short-term price reversal may be within an intermediate term trend. So when you're able to see these, you're able to move in and out or hedge your position for the move down, because as I said, sometimes the down moves get exaggerated because everybody is so bullish on the market, nobody's protected on the downside. So when you get a little move, it sometimes gets exaggerated, and you see 75, 100 points to the downside in a very fast manner. So sentiment is considered by many as the missing link in market analysis. And as I said before, there's I really only know of one other person that tracks investor sentiment. I know there's a couple other sites out there that do it. But the thing is, when you have the other side, like the websites that are out there that have investor sentiment, one of the biggest issues with that is they're not tracking the same. They don't know who's actually coming in and giving their sentiment readings, how they feel about the market. So when you don't have consistent people giving you bullish and bearish say readings about the market, your numbers get skewed. And that's one of the things where, like I said, Woody's one of a handful of people in the world that actually has a database of sentiment to be able to read sentiment, and he's been doing this for over 40 years. So it's only data, it's only a component of the market, and that's just one of the things where what we're saying is, if you get a high sentiment reading, it doesn't mean that the market has to drop. Sometimes it's a confirmation of a breakout. And again, I'll show you some of these examples as we move on. But Woody's been collecting this data for over 40 years, and it should not be confused with any other sentiment data. And it's not a trading system. It's just a powerful way to diagnose the market and understand what's going on. So this is kind of just a layout of how it works. So you have, this is the sentiment data that comes through, but there's different polling things. And by the time the sentiment comes in, we're able to see exactly what investors are feeling about the market. And this is an example. This is what we show our subscribers on a weekly basis. But you can see these are all coming in at whether people are bullish or bearish on the market. And when you get a 99% bullish reading, or you get a 2% bullish reading, a very low one like that, what happens is that does mark tops. But notice when we had the low sentiment here, that was your V, but here you can see a series of bullish readings, and that's just a confirmation that this market was breaking out at the time. But you can see the moving average of sentiment was going down, so we were getting these high spikes, but the overall daily sentiment was moving down, so we had a divergence. And then once it popped up to the 99%, that was the top. But this is a short-term sentiment reading, and it's one of the things that we provide. And then we also have a 10-day moving average of our sentiment. And again, when it just like regular technicals that go on, you can see when it starts to diverge, it sometimes gives you a good opportunity for the market to reverse. And the same thing is on the downside. When it's going down and now you see sentiment starting to go up, it actually marks a very good buying opportunity. So knowing where sentiment is at all times, it's really is just one of the most crucial things that I know it's changed the way that I view the market, because I know that there's not a lot of people that follow or even understand sentiment. So when you're able to see this tool on a weekly basis, each week, to see exactly where and what and how investors are feeling about the current trend, for me as a technical analyst, it makes my job easier, because if I know that we have sentiment that's kind of low, or we're topping on this, for me to be able to start looking at divergences, or start looking at wave structures, which I do all the time, it gets me on the correct wave structure a lot more. Because when I know there's a time period that I'm supposed to be, expecting the market to top or to bottom, from there to do your Elliott wave structures, which I do on a short-term basis, but then to be able to see sentiment on top of that, it actually gives us an unfair advantage over many other sites that just do simply Elliott wave tracking. So this is kind of how the formula works with it, is that when the market is heading down, when everybody's euphoric on the market and we start going down, what happens is it starts going up and down on it, and nobody's really worried about anything, because it's not going down. So we're getting those high sentiment readings. But once it starts hitting it, you start getting a little bit anxiety, then you get denial. Once it starts going down more, now people are fearing. And the way that institutions, the way that they really work this market is that once we start getting into this euphoric area, they're unloading their long positions, and they're starting to build a short position. And once it starts coming down and we start getting panic, guess what the institutions are doing? They're covering their short positions and they're building long positions. They don't have to be exactly right on price, but they know that if they're following the actual formula, they're going to be right on it. And when the market starts popping up, what are all the people that were bullish on this market that are now bearish on the market? What are they going to do? As it's coming up, they're shorting the market until what happens? They get squeezed out of their short position. From that, we start going into the optimism and excitement part. Institutions start selling their long positions and swinging to the short side. So if you just kind of follow where people feel about this market, and even if price goes the opposite way, when you start getting towards the end of a run and you're getting the extreme bullish sentiment readings, typically price just gets very choppy. You don't get those wave threes where things just can continue to go straight up. You start making a high by 8 or 9 points, then the S&P drops 25, 30 points, goes up, makes a new high by 8 or 9 points, and then drops 25 points. And that's really where, knowing where the sentiment is at all times, it's really is a great way to kind of guide where this market's going. So again, as I said, we're working off of our matrix where we have time, sentiment, and technicals. And that is, the time is the when, the sentiment is the why, because the herd mentality, and we have our technicals, which we try to determine where. So let's take a look at some actual calls on this, and then from there, I will go into where we are right now and what I see going on, some of our most current sentiment readings, and what we see playing out. So this is going back. This is our August 4th, 2015. So I'm showing you that because what we're looking at here is that we have a potential. What he had said in this report was there's a sell zone that's due between August 14th and the 21st, and he was calling it the kill zone. So let's move on and see what's going on. So this is during that same time period. You can see that we had an extreme bullish, everybody was bullish on the market from these levels here. And if I go one more page, and now we're going to take a look at the technicals, because we knew when to expect the top that was coming in. That was between August 14th and the 21st. We knew sentiment had the extremes, so now I'm going to go through the technical aspect of it. And what I was projecting on it was very similar to the previous presenter, was an ABC pattern that was going to be playing out. So the top area that we were looking for was anywhere between the 2092 up to the 2104 level. And if I just move it to the one more slide here to show you what happened, this was the August 4th report. This was that up and down move that we were looking for. It topped exactly at 2104. And from there, we saw the S&P drop almost 200 points in 5 days. And that was, you know, just one of the, it was a great setup on it, but it's showing you how when it is almost 2 weeks before this actually happened, that you were able to anticipate when this top was playing out. And as we got closer to the actual date, we saw sentiment spiking up, because remember, we weren't really that far off the highs from this level. So nobody was really panicking about this market. Everybody thought we were heading up to new highs on it. And that was as we were going right into this kill zone, into the resistance area. And like I said, from there, we saw an absolute, the market got crushed on it. So again, that's using your time, your sentiment, and your technicals to determine when, why, and where. So let's move to another example here. So that was right after the August, the drop that I was just showing you. And this is the September 3rd issue here. And what he was saying was that there's high volatility that's coming in on 9/17. So this was a specific date. Then he had said that there's a black hole that's actually due in Q4. So that is coming in, that's a months in advance that he was letting people know what the black hole, and what the black hole is it's a large drop. But what happens is it sets up a fantastic buying opportunity, because the black hole is when, you know, we're looking for that low, and it's a panic low. And from there, you're going to see sentiment that's going to go into extreme bearish levels. And from that, it ends up being a great buying opportunity. And what he was saying was that the longer that the market looks corrective, the better the buy setup. So again, let's take a look at what was going on at that time period. And here you can see that we had some, this is after the big drop, 0% bullish. So everybody was bearish on this market here. From there, we started getting pops back up, and now look what's happened. They all started turning bullish again. Now, let's go to what was going on. Here's 9/17. This is the exact date. From there, we saw the S&P drop, I think, 80 points, and it was in about a week's time frame. But again, this was when the report was out, so you knew going into September 17th that there was a big drop that was pending. Now, also notice on a technical aspect what was going on. We were getting very, very close to the 50-day moving average, and it just set up a great shorting opportunity on this. But remember what this was. This was going to be a good buying opportunity once that was done. And if we take a look at what was going on, here's your 917. This was a buy opportunity. Here's your fourth quarter. Remember the black hole that I was talking about? This was what took place on it. And this was the best buying opportunity. And from there, we had a massive rally that was going on. And it was, you were able to set your, really your positions way ahead of time, because you knew when these technical turn dates are coming. We knew that we had sentiment that was actually supporting when these turns were coming. And from there, we knew we had the technicals that were also supporting everything. So again, the 917 was the drop. And remember, this was after the big drop that we saw here, 917. So just these two moves alone was probably over 275, 280 points in the S&P from August until October. But again, this was the buying opportunity heading into the fourth quarter black hole, which set up the best buying opportunity. And from there, we really haven't even looked back on that. So let me move to our next slide. Oops, sorry. Here we go. Okay, so this is on October 20th, and this is 2016. So not that far, back. I'm trying to show you some of these our reports that we put out leading into where we are today. And what Woody was saying on this on October 20th is that there's potential for recovery post-election. Now, if you go back and you remember what was going on right before our elections, we had Mark Cuban, I think, came out and said that if Trump wins the elections, he's selling everything. Everybody was actually anticipating the market to crash if he got elected. And this was something that was put out on October 20th, that there's potential for a post-election rally on that. Now, if we go and take a look at things, here was this was going October 20th. We had a nice decline, and we fell right into the 200-day moving average. Election day was 2 days later, and from there, this is the post-election rally. So again, you knew 2 weeks ahead of time not to listen to the media, not to listen to whoever was coming out and saying that the market was going to crash if he got elected. And if you just paid attention to the technical timing indicators and what was being said, we knew that we had a technical buy. If we go and I think it's the next one, let me take a look. We don't have it. If you remember, we had sentiment that was at, here it is. This is the sentiment. We had 2% sentiment going into this. So we had traders that wanted nothing to do with on the long side. We knew we had a post-election, so we had the time period. And then if I go, you remember what? Oh, hang on one second. I'm sorry. I'm trying to. Just sorry about this. Okay, so this is where we hit the 200-day moving average. So we had time going into this period. We knew we had sentiment that everybody was bearish, and we had a technical buy, and that set up a great rally that we were in. So let's move on here, and now we're going into August of this year. And again, it seems like August is a lot of times when we get these big drops. And what he was saying on this is on August 8th, that we hit a 92% bullish reading, and that August was supposed to be the most negative time period that he's seen for some time. Vulnerability could extend into the fall. So now I'm going to show you where I showed you some great calls where the S&P has dropped 200 points, but now I'm going to show you that sometimes it doesn't always work out that way. And here you can see we had sentiment that was supporting the move for the August drop on it. we know we had a technical divergence here, as I'm showing you right now, where the S&P was on the top, and going, when we saw the 92% sentiment reading, that actually did produce a drop. But remember, we were looking for a very, very bearish market in August. So we got the initial move down, we got a pop up, and we got another move down, but unfortunately it stopped there. So we were anticipating that this market was going to go much further to the downside. We had everything that was supporting it, but we knew once it took out this level here that it was the bearish trigger view was gone, and from there the market rallied. So we made points on this move, but it ended up being wrong, and we had our stops set because this was a 92% bullish reading. So there was no way that the market should have went through that. It should have held it down to support. And once it took it out, the bearish view is done, and it wasn't a get overly excited on the bullish side. And the reason why was just the way that the wave structures were set up. And again, we've gone higher, we've gone a lot higher than I expected. But the thing is that there was no, the short entry part of it was here, that was taken out. I mean, it was stopped out. So now you just kind of wait for things to play out. And this is where I'm going to get you into where we are right now. So as you see this wave structure, if you guys don't know Elliott wave, basically what we're looking at is, you look for 5 waves, and it's important to understand that it goes on a short-term, let's say, basis within a longer-term view as far as Elliott wave and the way things work. So this is a 60-minute view of the S&P. And if you look, you can see that we are making this wave 5 right now. Now, the reason why it's important is now we're seeing a huge, everybody's bullish on this market. Nobody's anticipating it to go down. But the problem with it is that once this wave 5 completes, it's going to be it's a larger wave 5. And if things, the way that I see them playing out right now is where the preferred count is that we are going to make a new high here, and we may do it this week or within the next couple of weeks. But once that completes, we have the bearish divergence in place. We already know that we have sentiment that is at extremes, and we have a time period that we're going to be watching that's within the next couple weeks. And once that happens, a lot of people are anticipating that we are going to be getting this Santa rally that we've gotten every time. And the problem with the way the wave structures are set up, the way the technicals are set up, the way that the sentiment is set up is that we may be having that Santa rally right now. Now, even though I'm showing you that this wave 5, once it completes, there's going to be a larger move to the downside on it on a daily time period, which I'm going to show you on my live charts right now. What that is showing is that this is only going to be a wave 3. So this wave 5 right here, once that completes, we are going to get a wave 4 and then a wave 5 up. And if I go and I show you the retracements, like I said, that I use a lot on it, and we just match them up and just say, okay, that's going to be the high. The typical wave 4 downs go anywhere between the 23% retracement and the 38% retracement. So these are your target areas on the downside. Now, we haven't seen a 150-point drop in quite some time. So once something like that happens, what's going to happen to sentiment? Everybody's going to start thinking that we're starting a new bear market and you got to get out. But once this wave 4 completes here, and I don't want to confuse you with Elliott wave if you don't know it, but once this completes, we're going to get another wave 5 that's going to take us up to new highs. So even though short term we are looking for that move to come to the downside, on a longer term basis, once that bottoms, we're probably going to get a larger move to the upside. But the way sentiment is setting up and the way this market is pressed higher at this particular stage, it's not safe to be blindly long this market. And the reason why is because that is the way that everybody is leaning right now, that this market will never go down. But we have wave structures, we have a timing profile that's looking for when the reversal could take place, and we also have a wave structure as well as technical divergences that are looking for it. So once this final wave 5 completes, don't be surprised to see a larger move to the downside. That's going to surprise a lot of people. That is going to take us someplace into this area here. And then once that completes, it's probably going to be a fantastic buying opportunity. So I guess right now what I'd like to do is just open the door. If there's any questions out there, I got to see if I can get this going here. Hang on one second. I'm not sure how this works on it. Okay. So anyway, I can't really see. Here's the chat. Okay, and questions. Okay. So is there anybody that, is there any questions that anybody might have that I might be able to answer? And the only thing, I just really can't see these too well here, so I'm not sure how to do this. Let me see if I can move this over. Okay. All right. I got any data for in 2017. Well, that's what I just showed you. So I guess that question was a little bit earlier on. But right now, like I said, we have we have some interesting time periods that are going to be coming, especially when you look at the where sentiment is right now and what the wave structure that is in play. I just wouldn't be too complacent on the long side right now, because once you have sentiment that's been compressed this much up to the on the bullish side, when it does actually have that little bit of reversal, it typically takes a lot of people by surprise. And when you have everybody leaning one way and nobody's protected on the downside, the moves get exaggerated. And like I said, the next wave that I'm showing, as far as I'm anticipating, it could take the S&P a lot further than some people are anticipating. So let me see. I can't. What is? All right. What is used to well, basically, it's Woody's proprietary sentiment data that he uses, and it's comprised of, like, you have stockbrokers, you have hedge fund managers, portfolio managers. So they're going by what a lot of their clients are saying too. So that when they give in their sentiment data, it's actually comprised of hundreds and thousands of people. So when that sentiment data is put into a system, that's how it generates the overall sentiment data that we get. Hang on. I wish I could open this thing up. Bear with me one second. Okay. I'm trying to read this because I could just see it in a small box. Okay, is sentiment your main basis of your calls, or just one of the factors? It's just one of the factors, Jen. What we basically do is, like I said, the first thing that we really go off of is the timing aspect of things. So if there's a timing profile that's looking for a top or a bottom, the sentiment is then used to try to confirm whether that top or bottom should be coming into play. Because if we're looking for a top, the sentiment is just hovering at 50%, there's no extreme sentiment readings, then the top may be very shallow and then head back up again. But if everything is lining up where you have a technical timing profile looking for a high or a low, you have sentiment that's showing extreme bearish or bullish levels, and then we have technicals that are either at support, resistance, or showing divergences, that's really what is that's the three-prong approach that we use to determine whether we're going to be continuing higher or heading lower after that. So, well, one last thing I want to show you, one of the deals that we're doing right now, just so you guys can get an idea as far as what we do, we're running a 2-week special. It's just $4.99. You can ask for your money back on that at any time, but it's 14 days. You'll get to see exactly how this whole thing works. And like I said, being able to follow Woody Dorsey, it's a fantastic thing, because there's not many people that have been doing this, especially in the newsletter industry, for over 40 years, and he's one of the few, and he's a master at market timing and a pioneer at sentiment. So when you're able to get a view that your JP Morgans, Goldman Sachs, or you're just, some of your largest financial institutions in the world, they're going to his institutional letter and getting very similar type information. You really want to, I like it because I'm trading on the same side as they are on it, and they're going to be right a lot more than just your regular regular Joe Schmo who are a retail trader that's out there. So that's about all I have. I'm a little bit about 5 minutes early, but if you want, I'm going to hang on one second. I'm going to see how I can do this. Bear with me. So I'm going to just put this into the box here. If you guys, if hopefully you can see that, I'm not exactly sure, but if you did the actual this right here, this will give you an opportunity to get to the 2-week trial that we're having right now. And like I said, we have there's a lot of things that are going to be coming around the corner, and the wave structures that are out there, it's getting pretty close to a topping pattern, and things are going to get a little choppy. So if you're interested in finding out, we have, like I said, the $4.99 for 14 days. And with that, that's about all I have.